Hi everyone! The CPI report has confirmed that inflationary pressure is more persistent than expected. This is an extremely negative factor for the US economy. However, it's even more bearish for the economies of the Asia-Pacific region and local shares. The risk of a recession in the US will lower demand for Asian exports, so investors will flee from emerging markets. According to yesterday's report, nearly 90% of the US CPI components saw increases of more than 3%. Although analysts had anticipated a rise between 8 and 9%, the indicator jumped to 9.1%. Such an increase scared investors. After a day, traders digested what happened. Now they are expecting the Fed to raise the key rate by an unprecedented 100 basis points. Policymakers shared their thoughts on the matter. The heads of the Federal Reserve Bank of Atlanta, Rafael Bostic, and the Federal Reserve Bank of Richmond, Barkin, did not rule out such a possibility. At the same time, the president of the Federal Reserve Bank of Cleveland, Loretta Mester, noted that it is necessary to act cautiously. She also added that there is no reason to raise the rate by less than 75 basis points. Analysts have already stressed that talks about a 100 basis points increase are caused by a panic on the Fed. In less than 2 weeks, the central bank will hold its meeting and announce a rate decision. Following their FOMC meeting scheduled for July 27, when analysts' forecasts will be either confirmed or debunked, the US dollar could advance. Such a scenario looks likely, given that the US currency as a safe haven asset is steadily rising amid economic woes in Europe and the UK. The Bank of Japan maintains an ultra-loose monetary policy, pushing the greenback higher instead of the national currency. Analysts are using words like recession, panic, and hard landing. This is why demand for safe haven assets remains buoyant. In today's Asian session, the US dollar index was trading at 108.62. It was moving in the intraday upward channel of 108.20 and 108.64. The greenback climbed the most versus the yen. The latter has been depreciating so rapidly lately that today, Chief Cabinet Secretary Minister Hirokudzu Matsuno has expressed concerns once again. He said that the Japanese government and the board are closely watching currency movements on forex. While the yen keeps falling, overseas investors have become interested in Japanese government bonds. There was a new record in the bond market last week. The number of purchased government bonds reached the highest level in 12 months. In total, foreign investment in Japanese bonds amount to 2,066.5 billion yen, up by 330.5 billion yen last week. It looks like the safe haven yen has a competitor. However, in the current situation, the yen has far more rivals, namely the Japanese stocks, the Bank of Japan, the Fed, and of course the US dollar. The yen managed to add modest gains amid a decrease in US Treasury yields and verbal interventions of Japan's policy markets. Nevertheless, the bearish bias will persist as long as the board remains dovish. The regulator is ready for a sharp weakening of the yen. On Monday, board governor Harukido Kuroda noted it. Therefore, dollar-yen pair has approached a new high of 139.14. It is hovering in the upward channel of 137.30, 139.39. As the risk-sensitive currency, the Aussie has dipped today due to a high correlation with the US stock market. However, it received support following the release of fresh macro stats. The jobs report in Australia turned out to be unexpectedly strong. In June, unemployment in the country fell to a record level of 3.5% from 3.9%. At the same time, the employment rate climbed to a new high of 3.6 million people. The labor force participation rate indicator reached a high of 66.8%. These figures signal that the Australian economy is rapidly recovering after the pandemic. It also gives there room for maneuver when dealing with inflation. The Australian dollar grew slightly amid upbeat labour market reports and expectations of more aggressive rate hikes. However, the bullish momentum didn't last long, so the Aussie dropped to 0.6738. Market participants are more concerned about a rather gloomy future, namely a recession and soaring inflation. Therefore, traders are unwilling to buy risk assets. Moreover, a sharp rise in energy, food and building materials prices in the second quarter in Australia may also significantly boost inflation. During the Asian session, the Australian and vs American dollar pair was declining further, moving in the range of 0.6731, 0.6786. Galloping inflation in the US is adversely affecting Asian markets. If investors abandon emerging markets due to a recession in the US or the European Union, Asian central banks will have to raise interest rates to protect their currencies. Central banks of New Zealand, South Korea and Australia have already switched to hawkish stance. Singapore's central bank has tightened its monetary policy today. It's crucial to stay up to date with the latest market news. To do so, watch our video reviews, subscribe to our channel and have the most relevant market news at your fingertips. See you!